Let me just open things up a little bit for any questions or discussion that you might have with regard to the security analysis. How is that coming along? Any curiosity as to what's happening next Thursday? So what I'm going to look for next Thursday, your deadline for the final deliverable, and that is I'd like to see everything repackaged into a single. I think a Word doc would be the easiest. So you could put your graphs in there. You can put your ROE decomposition. You can put the output to your valuation if you want to put it in as a JPEG into your Word doc. But everything in that single Word doc, I would like to see a table of contents in there so that I know what I'm looking at. I can find it and so forth. And you're going to upload that on Wednesday evening at midnight. So that is the final deliverable for this project. That's also going to include all of the things that you have yet to finish up. And most of that is a narrative type of thing. So you're going to have additional narrative about the investment catalysts and things of that nature, some of the major assumptions that are going to affect your valuation estimate. You're going to have that front page, that executive summary that puts all of the important elements in one page. And then all of the other work that you've done up to this point. Now, I don't expect you to give me the pro forma financial statements in this Word doc, but I do expect the graphs. I expect the ROE decomposition. I expect the work that you've done looking at the operating leverage, things of that nature, the links to your sources and things such as that. So take some time. It's going to take you a good day, I would guess, to really pull all that together. So don't wait till Wednesday at about 8 p.m. and expect to pull that together in a reasonable, professional fashion. So up to this point, a lot of what you have done is to lay the groundwork for what I hope you will be working on for the next week. And that is to say, you've got the data now. You've got the information. You've got the macro forecast. You've got the industry forecast. You know what Sprouts is doing vis-a-vis its competitors. You've actually defined those competitors yourselves. And now, and you've done your valuations, your growth estimates, so on. Now it's up to you to figure out what's this all mean and condense it down to a couple of words. It can be strong buy, hold, sell, or strong sell. And in particular, as I mentioned in the assignment, since you're not beholden to an investment bank and the investment bank is not trying to curry favor with Sprouts for any reason, unlike investment bank analysts and just analysts in general, which tend to be severely biased towards hold buy and strong buy, you don't have to have that bias. You can walk into this with the assumption that all 5 of these categories are open. Sell or strong sell may be an alternative, depending upon what your analysis reveals to you and how you interpret it. Also, remember that the grading on this is not based upon whether your opinion agrees with my opinion. We both have an opinion as long as we both support that opinion with data and facts, we're good. If you don't support it, that's where I'm going to knock you down on the grade. It's not because you said sell and I said strong buy. It's because you didn't support why it's a sell. And likewise, if I didn't support why I had strong buy, I would equally knock down my grade. So make sure that you're supporting all of these statements. And by support, I mean, you might get different valuations. In fact, it's likely you get different valuations out of the 3 different methods we've used, right? We're using the DCF, which comes out of that pro forma financial statements that you've done. We're doing the residual income model, and we're doing the relative valuation using PE. So those things are probably going to give you some different answers in terms of is it buy, seller, or hold. And as a result, you're going to have to analyze the inner workings of those models and determine for yourselves, what do I think is the most credible thing? Which is giving me the best answer, and which is the one that I'm willing to put my money on the table and go with this particular direction. So that's what I want you to be working on this week. Now, obviously, you've got some writing, you've got some organizational things to do too. I would get started on that as soon as possible as well, so that you're not left scrambling to throw things together. And remember, if I can't find something on your report, I can't grade it. So it behooves you to be careful, put together a good, solid table of contents. And if you even want to link it where it's a hot link, I can click on the link and go to that spot in the table of contents. That's even better yet, but not necessary. I do want to see a table of contents of some sort, though. That latter part would all depend upon your expertise in using Word and that sort of thing. But anyway, you get the idea. And obviously, you can use, there's a table of contents functionality, if you will, in Word where you can actually tag a particular section. So even if you plug something in between that and the earlier material, it'll update the pages and so on. So I would take advantage of that where you can. Okay, what am I missing? Any questions that generated, or any other questions that you've been waiting on? Zach, go ahead.
Yeah, I have a question just in regards to that final kind of turn-in we're doing. Is there somewhere that kind of says, like, we need this, this, and this? Or is it kind of just all of the data we've accrued over the past few weeks?
It's pretty much the latter, but if you want kind of more of a cookbook, here are the items to make sure I have, go to that back page. That's what I'm going to use for grading, the back page of the assignment, and that'll show you the basic elements of all of this. And like I said, obviously, you can't really put the pro forma financial statements into the Word doc, but you can certainly put all of the graphs in there and things of that nature. So use some judgment in terms of constructing that. Obviously, the pro forma financial statements will be an Excel sheet. I'd also like to see the Excel sheet where you construct the graphs. But in terms of the actual graphs and the narratives, and you don't need to give me the macroeconomic forecast itself as much as I want to see the link to the forecast that you used. So if you got it out of Bloomberg, you're pretty much going to need to give me the whole thing. But if you got it off the web somewhere where it's just a URL, you can put the URL in there. For the articles and so on, again, URL is fine. So try to be as succinct as possible when you construct this thing, and take advantage of the fact that we don't need the physical document as long as it's out there on the web. Does that help? And I would say more is better than less. If you have questions, you get to a point and you say, "Hey, would you take a look at this? Just send it to me, and I'll have a peek at it." And by the way, I have not had time in between now and the time you turned in your second deliverable, but I will try to get time either today, at worst case sometime tomorrow. I've got like 4 or 5 meetings though tomorrow, so it's going to be tight. But I will get you some feedback on that too, so that you can make some changes and alterations to the second deliverable. Any other questions, Kristen?
Yeah, so I was just wondering, I saw on Canvas that there's links for like Chipotle, like the one that they did last year. So is that something good to like base our final off of as we're putting it together and kind of use as a reference?
Let me take a look at that particular thing. I'm trying to recall exactly what I put up there, honestly. Let's see. Was that the material from Ms. Bonacci that you're thinking of? There are several items that she shared with us. Let's see. Let me go to the modules.
Chipotle PDFs. It says like like Chipotle one PDF, and then it looked.
Ah,
I just
yeah.
like briefly looked at them, and it looked like 2 and 3 were somewhat of a combination for some stuff, or was that just like example information for Chipotle?
Let's see. So let me switch over to my iPad here.
I'm looking at it again, and it looks more. There's just like example information. So I'm not sure what I was saying before, but it might not be an example.
Yeah, these are some things that Miss Bonacci, when she was at KeyBank, she had one of her analysts that's still there who initiated coverage of Chipotle. So this was his write-up when KeyBank initiated it back in 2018. So Eric Gonzalez. And then let's see the other two items. I think they were just additional data on Chipotle. Yeah, some of the key trends.
I was just wondering if there was possibly like I guess like a basic template that we might be able to see of like how you'd like it set up.
Well, yeah, I mean, the closest would be the Darden. I mean, this is an actual fully detailed analyst report on Darden. Now, a lot of these things I'm not asking you to do. So this is kind of the professional version. What I'm asking for, in some cases, is more detail in the how you did things, and less detail in the analysis that is contained here. So they've got research notes and company news. Now that's going to be the equivalent of what you give me for the links to the articles that you've read about Sprouts and the industry and so on, and where it's headed. Here they've got various other analyst recommendations. So I didn't ask you for that. So there'll be some things in here that you won't have. But this is what a person in the industry would produce. You know what? Maybe it's. Let me go back through the assignment, and how about if I come up with a kind of a generalized table of contents for you all to work from? Maybe that would help specify some of this stuff. So give me a day or two again to do that. Like I say, I've got several meetings in the next couple of days, but I'll try to fit that as well as going through the second deliverable and giving you some feedback, and get that to you by the end of Friday, or possibly even maybe early Saturday, so that you've got something to work from. But certainly you can still get started ahead of that, but that'll give you a better framework. Maybe will that help?
Yeah, that would be very helpful. Thank
Okay.
you.
All right. Good. You're quite welcome. Any other questions? Okay. As things develop, feel free to reach out, and we can set up a Zoom meeting or a phone call, or just via email, whatever works for you all. And with that, let's jump back in. How are we doing time-wise? Okay, good. So let's jump back into the option valuation. And here we are looking at, I'm going to go back through the last thing that we talked about on Tuesday. So here we're trying to figure out, well, how in the heck do we price these things, these options, since they have different values depending upon the value of the stock at the end of the option, on expiry, if you will. And one possible answer began with, let's pretend for the moment that we have a 1-year option. It's a call option. It has a exercise price of 110, right? The current stock price is 108, and the risk-free rate of interest is 10% over that period of time, right? We also know two other very important pieces of information: that the stock at the end of this year will either be worth $130 or $115. Now, again, I pointed this out Tuesday, but let me reemphasize this. This is obviously a a completely unrealistic assumption that the stock will only finish in 1 year at 130 or 115. But this is just to give you the basic understanding of what we're going to do. Then we're going to expand this model. We can easily expand the number of prices that we have at the end of the year from just 2 all the way up to an infinite number of prices. And we can do this using calculus, basically. We won't have to actually use the calculus ourselves, but that's what's embedded in this Black-Scholes option pricing model. All right, so if these are the prices at the end of the year, this is our risk-free rate, this is the current stock price, and that's the exercise price on our call option to buy that particular stock, then we can figure out the intrinsic value in both of the outcomes in the future. So it's either going to be that the option will have a payout or a payoff of $20, or it'll have a payout of $5. And it's always going to finish in the money, which means that the put option actually is always going to finish out of the money. And remember, this is a put option with an exercise price of 110 as well, and the same time to expiry, 1 year. So here, if the put option, let's think this through. If the stock price is 130 and we have a put with a exercise price of 110, that put option gives us the right but not obligation to sell through that contract at $110. So if we were to buy the stock in the market at 130 and sell it through the option contract, we would lose $20. So obviously we wouldn't do that. We would not exercise. That's out of the money. Remember, because we have the choice to not exercise. It's the right but not obligation. And likewise, if the stock price finished at 115 even, that would still be the case, because why would we ever buy something at 115 and sell it for 110 unless we had to? And in this case, we don't have to. Okay, so with that in mind, let me just refresh your memories about this put-call parity relation. You saw it for the first time. I think we looked at it last, I don't know if it was Tuesday, or maybe we touched on it a little bit at the end of Thursday last week. So this is all relatively new to you all. And I've found that this sort of material takes a while to sort of sink into our brains. I think I shared with you that my first derivatives class when I was a doctoral student, almost all of us were clueless for the first half of the class. It takes a while for this sort of material to relate to our brains somehow. So let's look at that put-call parity relation again. So here we have a call, and this is a long call. We're going to add to that a bond. And we're either lending or we're borrowing. And if we lend, then we get an interest payment to us that comes to us. If we borrow, then we pay that same interest payment. In this case, this is a long bond. So when I write the K e to the minus RT in my formulas, this would be a plus. Because remember, the bond has has a face value of K with it, and we're taking the present value of it using continuous compounding. That's what that e to the minus RT is. We'll talk more about that e to the minus RT in just a minute later on in the slides. Okay, so anytime I see that plus K, that's a long bond, and you can think of it as either, I'm getting the contract and I'm giving money to the counterparty, or maybe it's easier to think of for instance, with say you're borrowing money on a house. So what happens there? Well, there's this thing called a mortgage. What a mortgage really is that is the buyer of the house giving the lender the right to repossess that house at some point in the future. So you can think of this as the borrower is giving the mortgage to the lender is giving cash to the borrower. So that's another way to keep this straight. So whether it's a plus or a minus on the K, a plus means that you're lending, a minus means that you're borrowing. So in this case, it is a plus, and you'll notice that right here, we are receiving that interest. That's why we have that line above the zero mark. And also, because it's a risk-free instrument, we get the same interest regardless of the stock price. So remember that this axis right here, this is the difference or the change in value of our instruments based upon the stock price. Well, the stock price is completely independent of the bond, right? We're going to get that interest regardless of where the stock price is, and that's why this line is just a horizontal line. It doesn't change with respect to the stock price. However, the value of the call changes dramatically with the stock price. That call has an exercise price of $50, and if the stock finishes below $50, that call is out of the money. And that's over this entire range, all the way down to a stock price of 0. It's out of the money. And our payoff to that call option is simply that we lose the premium that we paid originally to get that call option. And that's why this green line, this slightly darker green line right here, is below the x-axis. So that's a loss. But the loss is constant no matter what the stock price is. If it's below 50, we're always going to have that same loss. If it's above 50, for every dollar above 50, we gain $1 on the call option because we have the right to buy the stock through the call at 50, and then we can turn around and sell it to the marketplace at 51, and that makes us $1. If the market price is 55, that makes us $5. Now, also note that since we're beginning below the x-axis here, it takes a little while for us to start making a positive net profit. So even though this is a $5 gain here, a gross gain of $5, the net gain, once I take account of the premium that I already paid, is less than $5 by the amount of the premium. All right, let me clear some of that off, just so I don't make this too messy. Okay, so that's our call, and that is our bond. Now, before I move even further than this, let me add these two things together. This is relatively simple to do. What I could do is I could draw a third line on here that combines this call with this bond. And because the bond is just a horizontal line throughout the entire range of stock prices, all I have to do is add that gain to my call. So what I would be doing, so this is the gain on the bond, right? At every spot, it's the same. So what I would do is I would add that gain to my call. And it looks to me as though it is just about equal. Let's assume that it's exactly equal to the premium, just to keep my drawing a little simpler. Okay, so that means that I'm going to shift my call line, the payoff to my call, up by exactly the amount of the interest that I'm earning on that lending. And obviously, this just shifts that line straight up to the x-axis. So that orange line is the net of the call and the bond. So actually, I could erase this bond line, and I could erase the payoff to the call, because this orange line right here represents both of those together. Now, how do I deal with that as the call starts to gain to the right of the exercise price? Well, I simply continue to add that same exact amount to the call. So here I get up to here, I add that amount, I just keep doing that. So what I end up with is a line that is parallel to my call and is above it by the amount of the interest that I earn on the lending. So that is my net position. And now I can actually erase the call and the rest of the bond. And that orange line then represents the combined position between those two. Okay. Now I add in my put, and my put is going to be a short put. So remember, that's a minus P. Change colors for that. So I'm going to have a put that, and I'm just going to sketch this in, and then I'll show you the actual line. It's actually going to come in, let's see. We have a short put, so we are what? Earning the premium, right? So we get to keep the premium, and that's going to be over here somewhere. And then when the price finishes below the exercise price, I start losing money because the counterparty, the buyer of the put, is going to exercise. They can sell at $50, and if they can buy at a lower price in the market, they will do so and then sell it to me, who sold them the put. So that line is going to look like this. So now I have the blue line and I have this orange line right here that represent both the call, the bond, and the put. Now let me combine the put and this combination line, this orange line. So I'm combining the blue line with the orange line. And to do that, I like to evaluate at the break point, right? We talked about this the other day. So at the break point of that combined bond and call position, I have a zero gain. At the break, at that same dollar price, at that same $50, I have a break point in the put, and that is the value of the put. It also happens to be the value of the call, the bond, and the put, all three together. Since this one has zero and this one has some positive value, that's it right there. Now, I could also go to where the lines cross each other. So right here, up there is one point where they cross. So that point, I just double that, and that will give me the value of the combined position. So doubling it gives me a point up here. And another spot where they cross is right down here. And doubling that, 0 plus 0 gives me 0. It looks like it's pretty close to 0. Now I have 3 points here, and I happen to know that when I combine these two options, basically a call that's been raised up a little bit by the bond, and a put, a short put, a long call and a short put, I happen to know that that's going to be linear throughout the entire range, because I actually have the same exercise price for both options, same expiry. And so I can draw that new line. It actually falls right on top of the blue line up until I get to the point of the exercise price. And it continues. And it's also parallel, even though I don't draw it quite parallel. It's also parallel to that call, that long call plus the bond. So that green line gives me this linear 45 degrees to the horizontal throughout the entire stock price range. And that line looks exactly like the payoff to a stock. And in fact, it's the payoff to this particular stock. So I've taken the call, the put, the bond, and combined it in such a way that I end up with a payoff that looks like the stock. So I've created a synthetic stock position. And so this relation is called put-call parity. And we use the stock, we use the bond, we use the call, and we use the put. All on the same, so the call and the put have the same underlying. They both have the underlying of that stock, and they both have the same exercise price, and they have the same expiry. But when I combine these four things, I can create this equilibrium. And by using any three of them, I can create the fourth. Okay? So, any questions about that? This is a very important relation. And if you don't get it at this point, that's going to cause your understanding of everything else to be fuzzy. So here I'll draw in the nice mechanical lines. There's my put, and then there is my combination of the put, the call, and the bond. And that looks exactly like the stock. So if I use that relation, wait a minute. My bad. So I can use that relation to do this pricing. And so I know that the put has zero value in this world. Remember, I have only two prices at the end of the 1 year, and that's 130 or 115. And that means that the put is out of the money in both outcomes, so no one would pay me anything for that put contract. So I can zero that out. It makes that one element go away, which is very handy because I have values for the price of the stock. I know what the exercise price is. I know what the risk-free rate is, and I know the time to expiration. With all of those known, then I can calculate the value of my call option. And in this case, that call option turns out to have a value of $8. Okay, so that's pretty much where we ended on Tuesday. But I did want to go back through this, especially the put-call parity relation, because it's so pivotal to your understanding of everything else related to option valuation. Now we're going to expand this a little bit and say, well, wait a minute. Let's allow for the put to finish in the money at some point, and let's allow for the call to finish out of the money at some point. And so what we're going to do is we're going to have somewhat of an up and down movement in the stock. So here we have a stock price, S. And remember, in this case, the stock pays no dividends, but the formula has been altered in such a way that we can actually use the Black-Scholes option pricing model to value a stock with a dividend as well. Actually, that's called the Black-Scholes-Merton model, but it allows us to value a dividend-paying stock in the same setting. But in this, to get the basics of it, we want to assume no dividend. So we have the stock price at the end of the period. It either goes up by the amount of the U factor. So obviously you can think of that as the up factor. Or it goes down by the amount of the D factor. And think of that as the down factor. The up factor is greater than 1. The down factor is less than 1. So suppose that the stock price today is 100, the up factor is 1.1, and the down factor is 0.95. So that means that at the end of the period, the $100 stock will either be worth $110 or it'll be worth $95. So kind of the same idea, right, as we were looking at in the other example. In this case, we start off at 100, and it either finishes at 110 or it finishes at 95. And this is our 1 period. Now, in the other example, we had it start at 100, and it either went up to 130 or it went up to, what was our other number there? 115. That's what I thought. So in this case, if we have an exercise price of 100, obviously that means that in this price move, the call is going to finish out of the money. It will finish in the money in this position. And note that the value of that call is going to be $10 in the up move, and it is going to be 0 in the down move. Now comes the magic. The magic is that we can set this whole thing up by using an arbitrage argument. And what we're going to do is we're going to create a portfolio where the payoffs in both the up state and the down state, the payoff to that portfolio are equal to one another. And if the payoff in those two states are equal to one another, what do we have? What kind of cash flow do we have? It looks like what other sort of security? If the payoff in every state in the future is the same, we call that security A. Yes? Say it with me. Heisenberg. No, that's not it. Rewatching Breaking Bad. It's a bond. And if the payoff is guaranteed, it's a riskless bond. So we know what the price of a riskless bond is. It's the risk-free rate of return. So we know how to price that riskless thing. So that's the magic to this, is we're going to create this, what we call a hedge portfolio. And the hedge portfolio is going to be 1 part stock, 1 part call. And that call is on the stock. And we're going to have a fractional share. We're going to assume that we can buy fractional shares. Maybe we're, hey, we've got Robinhood now. We can always buy fractional shares in Robinhood. So it's not even not that big of a leap in terms of conceptualizing this. But that's how we do this. We have a fractional share of stock, and we buy 1 share's worth of call. Or rather, in this case, we're actually shorting that call, but we have 1 share's worth of call. So we buy a fractional share of stock, and we sell 1 share's worth of call option. And again, don't get confused with the fact that a call contract has 100 shares in it. Right now, we're abstracting from the real world. Okay? We're assuming that we could buy 1 share worth of call. So let's think about what that looks like. That would, in our payoff diagram world, that would give us the share of stock. Now it's fractional, so I don't know the slope of this, right? If it was 1 full share, the slope of that thing would be 45 degrees. So for every $1 increase in the value of the stock, I get a $1 increase in my position, in my holdings. Now, if it's fractional, if it's less than one share, then actually the slope of this thing is going to be something less than 45%. It might be 30 degrees. It might be 20 degrees. It depends upon what fraction of a share we're buying. If we bought 0.5 shares, that would mean that the slope of this thing is 22.5 degrees, right? Because for every dollar increase in the stock, we make 50 cents because we only have half a share. So the slope of this thing might be like that, or it might be like this, depending upon the fraction that we're using. Now, selling a call, we know what that looks like. That looks like this. Turns out that, as you know from your reading, that this happens to be called delta and is represented with the Greek letter delta. And remember, in this case, we're not using delta in the traditional sense that you might use it in math. Oftentimes we talk about a delta, which simply means a change. Here we're talking about a delta that is a fraction. So they're using the nomenclature in a slightly different way. Same symbol, different meaning. Okay, so let's clear that out. Okay, so now we have this portfolio that is delta shares of S of the stock. And remember, there's that implied plus out there. And short 1 share worth of call option. So what is the value of this portfolio today and at the expiration price? Well, let's look at that. And we can use this, what we're going to see, and begin calling a binomial tree. Binomial because there are 2 outcomes, and tree because in the end, we're going to end up having this thing with multiple nodes to it. And multiple outcomes. And so we've got, I didn't draw this very clearly, but you'll see it in a later slide. We've got multiple prices, and we've got multiple nodes. So we've got 1, 2, 3, 4 periods here. And let me just show you obviously this thing here. This is what we're headed towards, right? Okay, so there's that. And, oh, doggone it, keep hitting the wrong thing there. Okay, so at the beginning, what's it cost us to buy this thing? Well, we pay for the stock, so it's whatever the delta is times the share price, and then we receive a premium on the call because we're selling the call. Now, if the move is the up move, we end up with a stock value of the fractional share that we have times the share price times the up move minus the value of the call, the intrinsic value of the call, because we're assuming that this is the expiry. The expiration date on the call is right there. If it's a down move, we still own the stock, that fractional share, but now it's of less value by the amount of the down move, and we still have the stock or the call position, the short call position. If the call finishes out of the money in this down move, then that turns out to be a 0. Okay. So what we're looking for is a delta that makes this value and this value equal to one another. So we can just set these equal to one another. And then we solve for delta. And when we do that, we end up with the idea here, we're just starting with this equality, right? We're going to force these things to be equal. And if we do a little bit of rearranging, we end up with that delta is the difference in the intrinsic value of the call option at the expiration date divided by the difference in the stock price at the expiration date. So in the case of our example, we have that the stock went up either to 110 or down to 95. The exercise price was 100. So we have either a $10 gain on the call, or if it went to the down position, we have a zero, or sorry, not gain. We have a $10 loss on the call in our position, or a zero loss. And the stock, it's either worth 110 or 95. And when we do that math, we end up with 10 over 15, or a hedge ratio, or a delta rather, of 2/3. So we want 2/3 share of stock that we buy, and we're going to sell 1 share worth of the call to create this riskless portfolio. All right. So if we set this up, let's see. Hang on just 1 second. I thought I'd fix that. Obviously not. Okay, so we've got delta here, and 1 plus r equals delta. Sorry, I should have had this changed over to, I don't understand why sometimes the delta shows up and other times it doesn't. Quirks of the iPad, I guess. This gives me the value of the call at the beginning of the period. All right, so it's the fractional share of stock times 1 plus the risk-free rate minus the up move plus the value of the call, the intrinsic value of the call in the up move. And I'm going to scale that whole mess by 1 plus r. And that's going to yield the value of the call option for me. So if we start putting numbers onto that, so we end up by plugging in our hedge ratio, or our delta rather, of 2/3, our stock price of 100, the risk-free rate of 3%, the up factor of 1.1, the value of the call in the up move of $10, and then we divide that whole mess by 1 plus the risk-free rate, we end up with a value for the call option of $5.18. And then if we employ put-call parity, which can be looked at in this sense, we can actually show that the value of the put with the same exercise price, same expiration date, and the same up and down factors, that the value of the put is $2.27 in this particular situation.
Will you have some examples of these on like Canvas before the final?
Yes.
Okay.
In fact, we can go through some of that on Tuesday. And I'll also have some exercises for you to work through. Yep. This part of it is really plug and chug. The real magic is back here by creating this riskless hedge portfolio. And the fact that, hey, I've got this, it's a hard concept to wrap your head around, right? Because I've got these two risky things, but if I combine them in just the right way, I can end up with a riskless thing. So I'm having the risk of each cancel out by the other. And so that's the real magic. Most of the rest of this is plug and chug, but we'll work through some examples for sure. All right, so we can use this to value a European call without a dividend. And there are many other variations on this that have been developed since Black and Scholes originally came up with the model that they developed. So we've allowed this now. We can value a dividend paying stock. We can value American style options. We can value a variety of options using this, either a closed form solution, or at least using this binomial option pricing method that we just looked at. And I'm going to jump over here because this extrapolates this into multi-prices at the end. So here we're going to assume we're starting here at the same point, and this is the same expiration date. This distance of time right here is the same as we had back in the original example where we just had one up and one down. What we have done is we've shortened the period between the up and the downs. So now we have 1, 2, 3, 4, 5 periods in between there. So this is still the same expiration time, but now we've broken it up into smaller periods. So here is one up, one down. Here is another up and another down, and then for that same interval, we have 2 of those. The other interesting thing to note is that this is a recombining matrix, because if I go down and up, I end up at the same point here as if I go up and down. And likewise, out here, I can get to this point by either up, down, up, or 2 ups and a down. Now, there are different types of binomial matrices out there. Some of them are non-recombining, so we end up at different points if we go up and down or down and up. But the one that we're going to be using is recombining in this sense. The other thing to note about this is that each of these periods we can set up that delta portfolio. And we can work back and figure out the value at the beginning of that up and down interval. Now, in order to start this thing off, we actually have to start at expiration. So we actually start right here. And we know that the value of C, and this would be up, 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 up. So value of up, 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 up. We know what that intrinsic value is for C. If we know the starting stock price, and we know the up move, the up factor, and we know the exercise price on the call, I can tell you what that intrinsic value is. And likewise here, I have C up, 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 down. I know that intrinsic value too. So I can calculate those two. So there's the C. I know what the S is, because that's also, the same up, 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 down, and then S here is the 5 ups. And then I'm looking for some delta there. And I also know that I'm going to be short the call and long the stock. And I know what the risk-free rate is over this interval, this period of time right here, whatever that is, some fraction of the time to expiration. And I can use that same technique that we just looked at, find a delta where the value of this portfolio is exactly equal to the value of this portfolio. I know what those values are. I can discount them back at the risk-free rate, because that is a risk-free instrument at that point, and I can figure out what the value of the option is at this node. I can do the same thing for these pairs, this pair. So now I'm looking at the 4 ups and a down versus the up, 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 down, down, right? So I've got 3 ups and 2 downs. And likewise on the S. And I can do that same technique, and I can come up with a value of the option at that node. And I'll do that for all of these subsequent nodes down here. Now I have 5 prices, 5 values, and I can keep iteratively working backwards. And I can develop the price for that by using this node and this node. And I can do likewise for this node and work my way back and come up with a value for that. And again, for these bottom 2. So I keep iteratively working my way back. Oops, I'm reversing the video, sorry. I keep working my way back to today. And by the time I get back here, I've incorporated all of this information out here and condensed it down into a single price for the call option. But the technique is identical to what we just looked at, where we only had 1 price up and 1 price down. Now, one more step, and we get to the Black-Scholes option pricing model, and that is that we make each of these nodes, let me go down here to this. We make the distance from one node to the next infinitesimally small. So we have billions of these little nodes in here. So at the end of that matrix, we end up with an infinite number of stock prices out here, or at least theoretically. And the way we do that is through the use of calculus. But luckily, the Black-Scholes option pricing model, we've got a closed form solution to that. We don't need the calculus itself. We need the calculus to prove it, but we don't need the calculus to actually calculate the value of the call option using the Black-Scholes technique. Okay? So that's really Black-Scholes option pricing model right there in a nutshell. Questions about any of that extrapolation there? I don't know if this is helpful, but I mentioned at the beginning of this that the idea behind this really comes out of physics, and it comes out of the heat transfer equation. So, you think about, we're out here. Let me clear off the screen. We're out here, and we're kind of working our way back to today. So if you think about that in the context of a heat transfer, think about the okay, we've got to go through the ad here.
From it and start
Here's
to
heat
vibrate
applied to the right
much more
side.
vigorously.
And as it
They then
agitates the
collide
molecules
with
and
the
they become
particles
more
next to it,
energetic, they
passing on
keep
the
bumping
energy,
into
and
molecules
slowly
over to their
down the rows,
their
each
left.
particles vibrate more and more
And they
vigorously,
continue bumping
passing
into
on
each other
heat
and
to
transfer
the
the
next
heat
one
through
collisions.
the
So
material.
it progresses slowly through
So
the glass.
the analogy is
This is
quite
how
nice
conduction happens.
in that we're doing the same sort of thing right here. We're transferring this back to today. It's loose, but you get the idea. All right, so this binomial, we could actually do the binomial by using computing power that we have today. It's fairly easy. We wouldn't even need Black-Scholes. We could make, they wouldn't be infinitesimally small, but they could be small enough that we get a fairly realistic look of prices at the end of the option. So a little bit, just a very little bit about Fisher-Black. As I've told you before, Fisher-Black is the mathematician and the mind behind putting together the physics heat transfer equation with the idea of valuing an option. Myron Scholes, equally brilliant, but he was coming more from the finance side of the concept here and brought the finance expertise. This is early 70s, so this has been around for something over around 50-ish years, half a century. And the value of this model, just the idea that now I can value an option, led to fairly rapid development of the CBOE, Chicago Board of Options Exchange. And as I said earlier, it was originally posited using non-dividend paying stocks, but it's been generalized since then to allow for us to value all kinds of different securities with different sorts of payoffs. So we need several inputs to this. The model requires that we know the current stock price. Well, that's pretty obvious. It also requires that we know the exercise price. Also equally obvious, right? Remember, we were talking about the minimum value of a call is S minus K or 0, right? Here's our S, here's our K. We need those things. We also need to know what the risk-free rate is. And that helps us to understand, you can understand why we need that by thinking back to that binomial example. We use the risk-free rate to get the value of the portfolio, of the hedge portfolio at the beginning of our time period because the payoff was risk-free. So we can use that risk-free rate. And then we need time, which again, fairly obvious. One additional factor that may not be quite as obvious, and this is represented by sigma. But this is not the sigma that we're used to dealing with. You're used to thinking of sigma as the standard deviation, and you're used to thinking of it as having some sort of implication in terms of volatility over a span of time. In the Black-Scholes option pricing model, this sigma is in what we would call an instantaneous volatility. The concept behind that is something that we can't really understand that well, but and this is actually the factor that is the most difficult to come up with, because we can't really measure that. And it's also, mind you, it's also forward-looking. I mean, the stock price and the time and the exercise price, those we can know with absolute certainty. The risk-free rate, yeah, is it going to be stable over the period of our option? Yeah, maybe, but if we've got a relatively short time to expiry, we can assume that that's also a constant. But this implied volatility, so it's referred to by two different terms: implied volatility or instantaneous volatility. And that one, we really don't know how to get. Now, people will guesstimate what it is, but part of the reason that this is called an implied volatility, and this is somewhat of the irony of this equation too, is that what people will do is they will use the price of an option, and knowing that we know for certain these four inputs, we can take those plus the price or the premium, and we can use the Black-Scholes option pricing model, and we can back into what this sigma is. Kind of bizarre. But that's how difficult sigma is to calculate, because it's this concept that we just have no idea what it really is. What's an instantaneous volatility? But that's let's not dwell too much on that, because we make some assumptions about what it is, and we use those going forward in valuing our options, and they change as the historical volatility of a security changes and as the expectations of the future volatility change. But I wanted to point that out to you, that there's a bit of a fly in the ointment, if you will, in terms of Black-Scholes, is that only 4 out of the 5 factors that give us the value of the call or the put option are something that we can know with certainty at the time we're pricing this thing. The other thing, this 5th factor, even getting it for just one instant out is very difficult. Here's the Black-Scholes option pricing model in a nutshell. And so here we have the value of the call is equal to the stock price. And notice the K over here. So really, remember, we were looking at the intrinsic value of a call is either S minus K or 0. There we go. Now, this element right here, this e to the minus RT, that's the natural exponential. And that is simply a means of getting the continuously compounded interest rate. So again, I'm shortening my period up to an infinitesimally small period. So I'm compounding on a continuous basis over this period of time t. So e to the minus RT. And remember, a negative exponent means that really I could rewrite that as 1 over e to the RT. So you can think of that, and then I'm multiplying that by k. So let me just substitute the k right up there. So that's really a discount. It's just that we're using continuous time discounting to get that. So I'm just looking at the discounted value of k here. And then I've got these 2 other factors, this n of d1 and n of d2. Those are a bit mysterious. And given that we're about 2 minutes away from the end of class, let me jump to the picture. All right, so let me go to the standard normal distribution function. This n of d1 and n of d2, basically they are what we call cumulative distribution functions, CDFs. And all it means is that if I have, let's say I have a d1 equal to 1. So n of d1 is, well, here's 1 standard deviation to the right of the mean. So standard normal, the mean is 0, and I have 1 standard deviation over to the right. So that means that d1 represents this point. The n of d1 says, tell me what the area under this distribution is to the left of d1. All of this. Okay, I know that to the left of the mean is 50%. And then I know that 1 standard deviation to the right is an additional 34.1%. So I know that the n of d1 for this is 84.1%, or 0.841. So all I'm getting is all of the probability to the left of that point, either D1 or D2. And we'll pick up on how we calculate D1 and D2 on Tuesday. Work hard on that security analysis over the weekend. Let me know if you have any questions, and I'll let you get back to relaxing a bit more. Have a good weekend. We're almost there, folks. Bye-bye.
You have a good one.
Thanks, you too.
Thank you.
Thank you.